everyone, and welcome to today's WayUp Summer Series event. I see a lot more people trickling in, so excited and welcome to all of our first timers. Thanks so much for joining, and for all of the returning visitors and attendees, welcome back. I'm Liz Wessel. I'm the co-founder and CEO at WayUp, and I'll be moderating today's session with Scott. Scott Birnbaum is amazing. So for those who are unfamiliar with Red Sea Ventures, they're an early, so they invest in companies at the earliest stages. If you're unfamiliar, or if you're familiar with vernacular, that's seed stage, sometimes Series A, sometimes even pre-seed. But they've done companies that everyone on this call is familiar with, from Ample Hills, which is one of my favorite ice creams, to Allbirds, which of course, everyone should try out Allbirds shoes if you haven't. Fancy. They've done Outdoor Voices. You'll learn a lot more. And they've also done WayUp. So you've all been familiar with WayUp. Obviously, you're on this call, and they are an early stage investor in WayUp. Scott has a really amazing background. Before VC, he was actually an operator himself. He started companies. He's been a lawyer. He's done a lot of different things, and we'll learn all about that throughout today's call. So with that, we are going to dive right in. Scott, how are you?
Great. Thanks for having me. I'm excited to do one of these again.
Yeah, thank you so much. And what just to everyone, what he's referring to is many years ago, he actually did this for our team at WayUp, and our team still, the employees who were there then, still talk about how much they loved it and learned about venture capital. So now we asked him if he could do it for you all, especially because he's invested in so many companies you all use and know and love. So Scott, thanks again. But let's start with just, you run a VC firm, Red Sea Ventures. Let's start with, what do venture capitalists do all day? Like, what's an average day in your life?
So the way that I think about the job is a few different buckets. We think of it as sourcing deals. So that's developing relationships with people within the tech ecosystem. That could be founders, it could be other venture capitalists, it could be angel investors, it could be people who work inside different tech companies and operators. And the idea is, through those relationships that we develop, where we try to make these as authentic and not transactional. Obviously, these are relationships that you develop over time. You hear about new companies, people that are interesting, people that are starting a new business, and sometimes we spend time with those people once the deal has been sourced or the relationship has been sourced. We spend time with them, sometimes helping them ideate on the business, refine the concept, think about how and when to raise money, who they should be speaking to in terms of raising money, helping to sort of direct their focus in ways that are going to be most helpful and productive for them. So that's sort of the sourcing. The second piece is the diligencing. So that's where we really start to dig into the business and understand how it's going to work, where the potential lies, what the competitive landscape looks like. Obviously evaluating the founders, which especially at our stage, because when we invest, it's at the seed stage. So it's usually a couple of people with an idea, sometimes a prototype of a product, but rarely any revenue or a real product. And so a lot of our time is spent getting to know the team and understanding what makes them tick, whether we think that they align with us in terms of how we think about their business, whether they align with the market, whether they, the sort of purity of vision that they have for the business that they're looking to build. And whether they've got the required elements to be successful with that business. And so that culminates ultimately into sort of an investment memo that we develop that pulls together on paper all of our analysis around the deal and its potential. The third piece is the transacting. So that's where we get into negotiating the deal, figuring out how the deal should be priced, what sort of rights are required, how to bring in the syndicate of investors that are going to participate in the investment with us or alongside us. And then the one of the most fun and rewarding parts of it is what we call portfolio support, which is basically working with our founders within the portfolio and helping to get them, in our case specifically, really spending the bulk of our time getting them from the seed investment. So when we first invest, to the Series A investment, which is the next round of funding, which in today's market is a lot bigger with much larger firms, and so many more people around the table to support the company. So that's kind of like the investing slice of the business. The second is the fund administration side of the business. So this is the certainly the less sexy side of it, and much more internally focused, where we have to maintain records and reports on our portfolio companies. We have to We have to run a bunch of different analyses on the data with our portfolio and of our performance over time to sort of be able to self-reflect on the type of work that we're doing and the success of the work that we're doing. We will, obviously, there's a lot of administrative reporting work in terms of reporting to our investors. There's auditing and tax work, et cetera, that sort of thing. And then obviously the just day-to-day administration of a firm. We have an office space, we have employees, we have things that we have to do from an administrative perspective. And then the last is you would bucket it as investor relations, which is your relationships with investors, either existing investors or prospective investors for future funds. And that's really a part sales game, part relationship development game, part just being a good partner in communication process. And that's time that you spend getting to know potential investors. It's time that you spend communicating what's happening within your portfolio and your performance to existing investors. And so that those are the three major legs of the business.
That's awesome. I did not fully appreciate everything in your role. That's a lot of stuff. When you started naming, and you have to basically be CEO of a company and manage all these employees in an office, it's like, oh my gosh, that's a lot. So Shark Tank, I think, is how a lot of people on this call probably were introduced to venture capital. And one of the things you mentioned was due diligence. And I'm sitting there thinking, like, I don't see the sharks during Shark Tank due diligence. So what's the difference for people who just heard what you just described and Shark Tank, how they see the deals happening? What's the difference between those two?
There are a lot of pretty fundamental differences. The one fundamental one is that we're not on a TV show, and so we don't have to pander the process to an audience that's watching for the sake of entertainment. These are much more authentic relationships that we develop with our founders, and that's a really important part of how and why we do the work that we do. So that's one of the major differences. The other major difference is that they make investment decisions within 2 to 3 minutes on TV, probably more like 30 to 40 minutes in person, if not a little bit longer than that. But that's a fraction of the amount of time that we take to get to know most of the businesses that we're investing in. Our typical process will take somewhere from 2 to 4 weeks. There are obviously some deals that move a lot faster if we already know a space really well, know a founder really well. But we try to be very considered in how we approach underwriting a deal and a team that we want to partner with for 10 years to come. And part of that, I think, is also related to the fact that when we make a commitment to invest in a company, we make a commitment to be their partner for a long time. Typically, we expect that to be somewhere between 6 and 10 years. And so if we're making a 10-year commitment, we want to be really sure that this is not only a business that we want to be a part of, but a founder's life that we want to be a part of also, and a product that we think is important to bring to the world. So it's a little bit, it's a different process, and it's probably a little bit more of or involved in a different way than at least Shark Tank is. And then the other major difference is we're not around the table with a bunch of other investors that are sniping at each other and competing for an investment. So while obviously there is competition in our market, it's a very different dynamic.
Awesome. Okay, so let's rewind a little bit. I think a lot of the college students watching this probably watch this and say, well, if I don't study finance, I probably could never get a role in NBC. Tell us about what you studied in college, and obviously you went to grad school, so you can talk about that as well. And what did you want to be when you were in school?
I'll start with what I wanted to be when I was in school. I don't even know if it's what I wanted to be, but I was always certain that I would become a lawyer and that I would probably transition into the business world at some point. My career ended up happening that way, but not in that order. What I studied in school, to your point about thinking that you need to have had finance experience, I studied political science and theology. And so, while I certainly spent time thinking a lot about business, I wasn't formally studying it in undergrad. And I don't think it is an essential part of building a career in finance or venture capital, which is certainly early stage venture capital, I think, is very different than typical finance because it's much less quantitatively heavy than typical finance roles. But I think that especially in venture capital, where a lot of the role is about thinking about where the future is going trying to read the tea leaves of cultural changes that are happening, business changes that are happening, macro events and how they will impact the rise of new trends or future trends is, I think, a lot more akin to a liberal arts education than it is to a pure finance education. And so I don't think what you studied in school matters. It matters, but I don't think it matters all that much to what you ultimately do if you want to work in venture capital, or, to be frank, in a lot of other careers, including finance. I think what matters is that you demonstrate while you're in school that you can be highly committed to your education, that you can succeed in a measurable way, and that you're able to put in the hard work that's required, so that the people who look to bring you on into their teams believe that that you've demonstrated a capacity to be a great team member in the absence of being able to try you out.
Awesome. And for everyone watching, if you like what you're hearing from Scott, our team member Brandon just put in the chat some of the links to Scott's positions he's hiring for today. So go ahead and please do check those out. Regardless of what level you are, those could be a really good fit. So thank you, Scott, for sharing those. But all right, so you graduate from college. You knew you wanted to be a lawyer and then eventually go into business. So how did you get your first job? Tell us about that first job out of college.
So the story of my first job is an unusual one, because during my senior year, I decided to start a software company. And so I was working on the idea with my best friend, and we thought we had a pretty good idea, and we sort of validated some things in the market that helped us believe that would be true. And so my first job was being the co-founder of a software business. And we ran that business together for 7 years. And it was an amazing experience. We ultimately sold the business, and at which point, while I was working in the transition for that company, I decided to go to make good on my promise to myself and actually go back to school. And so I went to law school at night while I was working for the company during the day, and that was a fantastic intellectual experience. And so, to the point earlier that I made about sort of making good on my promise to do to myself to become a lawyer and then go into business, I just did it in a reverse order. After law school, I ended up going to work as a lawyer for a couple of years, and then worked my way back into the business world and the tech world. First at CBS, and then starting this fund.
Awesome. And I'm not going to ask you more about that right now because we're getting a lot of questions about that. So I'll let the attendees ask you about that transition. But fast forwarding a little bit to your career in venture capital, a lot of people on this call would probably love to try out venture capital, but they maybe don't have any connections to the world. They don't have any money to angel invest on their own to build up their own portfolio and resume. They lack the network. So what do you recommend for people like that who really want to break into VC?
So look, venture capital it's a very small industry. There are not many people employed in the venture capital industry. And so as a result of that, it's not an easy industry to break into. And so, and also as a result of that, there are no clear paths into venture capital. Everybody has a highly idiosyncratic story about how they ended up in venture capital, which I think is probably why very often it's like one of the first questions that people will ask is, how did you get into venture? And the answer is almost never the same. I think so. If I had to build a roadmap for people on how to get into venture, I think there are a few paths that are most likely, although not exclusively the paths. One is to work at a tech company, get a job working inside a tech company, learn the ropes of that business, understand what makes a tech company work, and leverage that experience and the network from that company in order to build relationships outside of your company at other operating businesses, as well as venture capitalists. There will probably be, if you work at a tech company, it's reasonably likely that it will have been venture capital backed. And so try to find ways to connect into the venture capitalist teams that have invested in your business, even if it's just a get to know you, would love to do a coffee, do something like this, like organize a Q&A for your fellow employees to speak with the venture capitalists and use that as an opportunity to get to know them. And so, basically hustle your way into building some relationships. Venture capital is in large part a sales game and a relationship game. And so in order to succeed in that space, you have to have the personality that allows you to draw energy from building these types of relationships and working that kind of hustle, so to speak. So I think that's one path, is starting at a venture capital, at a venture-backed tech company. The second is working at a venture capital fund. There are some large venture capital funds. I'm thinking of firms like Insight, specifically, that employ large groups of recent grads in sort of an interesting 2-year analyst training program. And so while there aren't many of those roles, there are those roles, and you can work there and you can get a really great experience with incredible training, a phenomenal network, and leverage that to continue into the industry.
And a quick plug to everyone, Insight Ventures is actually a big client of ours who does a ton of hiring through WayUp. And Scott really means it when he says they hire a lot of recent grads. So I'll share the link to their profile if anyone wants to check those out. Although first, check out Scott's roles that are also linked there.
Very, very different. The roles don't compete or overlap, so it's very different. But thank you, Liz. So I think that's a second path. And then the third path which is, a much more corporate, straightforward path, is go work in consulting or banking. Those tend to be really good paths towards venture capital, ultimately, because a lot of the professional rigor you develop inside those organizations, the training you receive, tends to translate pretty well into working in venture capital. And it also gives you an opportunity to build a network, not only of coworkers, but of colleagues across the industry that you may be servicing, that will help you get exposure to the types of people you need exposure to in order to break into venture capital.
Awesome. Okay, based on time, I'm going to ask you one or two questions, and then we're going to switch over to the audience questions, because there's some really great questions coming from the attendees. So for the college students who are on this college, maybe have another year or two or more left in school, any good classes you'd recommend they take? Like, you talked about the benefits of a liberal arts education for venture capital. So any good classes that you can recommend they take?
I think the classes that I thought were interesting, and that I hear a lot of people in venture capital or in tech taking in their last years in college, are around entrepreneurship. So a lot of universities and more universities are investing in an entrepreneurship program. So I would try to take those classes. There are, I think a corporate finance class is an interesting class to take, because it'll just, even though it's not fundamental to at least early stage investing, understanding the vernacular and what will really help you position yourself well in the industry. If there is a class specifically around venture capital, that's great. That sometimes there are some classes around innovation that'll help you look at and understand future trends. So I think those are all interesting classes that I would recommend people try to opt into. And by the way, even if you don't have, even if it doesn't sort of match for whatever logistical reasons into your schedule, or it doesn't match to the credits that you need in order to graduate, and you're sort of at the tail end of your college education, you can go in and audit those classes, and don't be afraid to go and ask those professors, even if there isn't a formal audit permission, to allow you to just sit in and listen to the class. And and really take that time, because it's really more about the information you can absorb than it is about the credentialing or having the credits or the grade on that particular class.
Awesome. And then the last question I want to end on, that we always talk about diversity in all of these summer series, and the venture capital world has been very much, been under the spotlight with when the Me Too movement was happening, et cetera. So you've been around in the industry for so long. I'd love to hear about any changes or interesting insights you've seen over the last decade or so of the VC world trying to bring in more diversity and not just everyone being from the same 3 schools or the same race or gender.
Look, what I'd say is that, so I think the industry overall, the tech industry and the venture capital industry are making significant strides towards more diversity and inclusion up and down the stack of the industry. That's not to say that it's where it should be. It's still very far off from where it ultimately should be. But I think there has been a generational change of the guard in the industry that has changed the perspective of the people who are doing the hiring and doing the investing. And so I think the network of decision makers within the industry has changed a lot. There's a lot more natural diversity within those networks. And specifically over the last 5 years, 5 to 7 years, there have been a lot more women entering the industry and taking leadership positions on investment teams as well as on senior management, as well as on the founder side of tech companies that are being venture capital backed. And I think that's also true for for people of diversity across the board. And so, for our portfolio, we about 30% of our founders are women, which is low relative to where we'd like to be, but very high compared to the industry.
100%.
And what we see happening is that because we're investing at the seed stage, we think our firm is maybe a little bit ahead of the curve, but that it is a part of the curve that's happening where at the seed stage there are more women being backed, and then they graduate. They sort of like graduate or matriculate into later stage financings. Their businesses get larger and larger, and that sort of perpetuates a virtuous cycle of increasing diversity and inclusion across the industry. So I'm hopeful for where we're going, but there's still a lot of work to be done.
Awesome. Great. I love hearing that. Cool. All right. We're going to switch to the audience questions because you are all asking way better questions than I could ever ask. So we're going to start with Ben Sanfilippo. Ben will be joining us on stage any second now. He's from Missouri S&T. So let's see if we can get Ben on stage. And Ben, you can turn your video on and your audio on. I see you're on stage now.
Hi, Ben.
Hi, I'm Ben. Yeah, and my question was, as a venture capitalist, what is the most important thing that you look for in a very early on startup that makes you want to invest in them?
I wish there were just one, but there are a number of things. And so, the way that we think about it is founders first. And so when we think about partnering with founders, we're looking for three things. We're looking for magnetism, vision, and discipline. Magnetism is the ability or the charisma to recruit people, to convince people to come in and work with you on this crazy adventure of an innovative thing that you're working on. Vision is having a vision for where the world is going, what the future will look like, and why your business will have an important place in that world. And discipline is the toolkit required in order to make sure that you can be an effective operator of a business, that you can be attentive to detail, that you can think about process, that you can be a good steward of capital, and a trustworthy partner.
Great question, Ben. Thank you so much. And Ben, maybe we'll see you in the entrepreneurial world soon. Awesome. All right. Next up, we are going to invite Joanne. By the way, have you said that answer before? Because that was like so perfectly articulate.
I have. And in truth, actually, I owe a shout out to Kristen Green at Forerunner Ventures. She was the first person that I heard package it into those three terms, and it sort of matched exactly how we think about it, but hadn't put it in those words. So I thank you, Kristen, for that.
Amazing. Awesome. Well, Joanne, I'll introduce you and then we'll go to your question. So you are currently working at Goldman Sachs and you are an alumni of Binghamton University. So go for it with asking your question and you'll just want to press unmute.
Okay, awesome. Thanks so much, Liz, and thanks, Scott, for having us. I actually had a question before regarding your background, how you transitioned into VC, but think you kind of answered that. So I was wondering, how you met your co-founder. I feel like the co-founder is super important because that's someone in the early stages where you have to do everything with. So what kind of qualities drew you to him, and how has it been working with him? And I have another follow-up question, but you guys can answer that first.
So when you're talking about the co-founder of my software company. So
yes.
It was easy. He was my best friend since we were 12 years old. So that's how I sort of met him. From an evaluation perspective, what I was looking for and what I think everybody should be looking for is, first and foremost, is it somebody that you can trust unequivocally? Do you believe that they will not only have your back, but also always do the right thing? The second is, or do you have complementary skill sets that are complementary for the business that you're thinking of building? If you both have the same perspective, the same skill set, the same experiences, then it's not really a 1 + 1 equals 2. It's like a 1 + 1 = 1.5. And so you really want somebody that has a complementary skill set, especially if you're building a tech company. If you have a technical background, then look for somebody who may be a little bit more on the business side and vice versa. So complementary skill set, and then obviously somebody, and this is a little bit how we evaluate founders as well, but people who are constantly looking to learn, self-improve, very self-aware, and the question that we always ask ourselves is this founder that's pitching us somebody that we would be happy to go and work for? Are we so excited about this person that I could see myself taking a job working for them? And so obviously, if you're bringing on a co-founder, that should be your question too, because in a sense you will be working for your co-founder.
So true. That's awesome. And you started Red Sea alone, is that correct?
Yep. Started the firm alone, and then my partner now, Paul, joined about 3 years into the firm, and has now been with us for about 5 years.
Amazing. And before we go to the next question, which will be from Zuhair Junetti, I am curious, what made you decide to start your own VC firm versus joining another venture capital firm out there?
It's interesting. I mean, when we started the firm in 2013, first of all, there were not many seed stage funds in New York that were focused on the New York market, which is a core focus of ours. It's about 60% of our portfolio. And so there weren't many firms acting in the space. I really wanted to build a seed-focused firm because I had that experience as a founder of trying to build something as a first-time founder from scratch. And the support that you can get from the people around you early on is a really high impact. And so I was looking for that from a fulfillment perspective, and I thought it matched well to my experience as having been a young founder. And then the other thing was, at the time, especially, it's much more common today, the concept of an operator venture fund, or a venture fund started by operators, was still sort of a newish idea. There were not many venture funds at the time that had been started by people who had operated tech companies. And so it was sort of our thesis that the empathy that you have as a founder, as somebody who's been a former founder, who's been through building a business, resonates loudly with founders. And so therefore building a firm that reflected those values, we thought had merit for existing in the world.
It's so true. It's when you think about talking to an investor who doesn't understand why you're talking so much about employees because you care about your team members who are in the trenches with you, it can be really disheartening. So I totally agree with that.
I also, just to add to that, I also think there's often a bias as a venture investor, as an investor in general, to sort of substitute your judgment for the founder's judgment. You sort of think that you can make the decisions for the founder. The reality of it is, especially if you've been an operator, you know that you don't have all the data points that the founders do. And sometimes those data points are articulable and sometimes they're not. And so once you've decided to back a founder, you kind of have to trust that their judgment will work both on an intuitive level as well as on an analytical level.
Makes perfect sense. Awesome. All right. Next up, we're going to invite on stage Zuhair Junetti. Zuhair is a student at the University of Michigan and is currently a consulting intern at Accenture. So let's see if we can get Zuhair on the video. Okay, great. And then you can turn on your video and audio.
Perfect.
Okay. So I just wanted to ask you, what makes someone who is really good venture capitalist, different from someone who is just an average venture capitalist? And a second quick question what are some startups that you've invested in over the past few years that have, been really successful?
So look, I think there are a lot of different ways of being a good venture capitalist. And it's sort of, you have to tailor your approach and the qualities that you have to the strategy that you're employing as a venture capitalist. For instance, some VCs are very research driven, very thematically focused, will only do a few deals a year, very, very focused within their sectors of expertise. And so in those instances, you need to have the desire and the capacity for that type of work. Other investors take a little bit of a much more trend and people-oriented approach, and so they have a little bit more of a sales-minded approach to the industry, and so that requires a different sort of personality. So I think there are a lot of ways of being successful in venture capital. I think it's and there are a lot of and in part that's because venture capital is backing this big macro trend around tech innovation that is nowhere near its peak maturity. And so there's a lot to be done in this industry. You sort of think of it as a little bit of a gold rush in a lot of ways. And so I don't have an answer for you on exactly what makes the right venture capitalist, because I think there are many different answers. Having said that, it takes a long time to figure out if you're good at venture capital. And the reason for that is because, especially in our case, if you invest at the seed stage, when it's a couple of people with an idea, it will take 10 years for that business to get to an exit, if not longer. And you don't really know if you're good until you actually start returning capital to your investors. And so that'll take a 10-year cycle easily. And then even once you're well into your 10-year cycle, you don't know whether you're good until you can repeat that. And so there's an investor that I have a tremendous amount of respect for, named Henry Ellenbogen at a firm called Durable Capital, who's invested in a lot of really amazing companies, some of which are ours. Which is maybe part of the reason why I love him so much. But he says that he's 30 plus years into this industry, and he says you only know if an investor is great if that investor has been tested by a crisis and has adapted their framework for investing to a new macro environment. Because otherwise you just keep repeating the same playbook, and that doesn't mean you're great. It just means that you had a playbook that worked at a point in time.
But what's so tough about that is we've obviously had a huge macro event happen in the last year that has forced everyone to change their ways. And yet tech as an asset class has been on the rise. And so I saw a stat recently that 75% of venture capital firms are currently reporting to be in the top 25% of venture capital returns. So it is a really tough one that some of my VC friends are asking, who are maybe much earlier in their careers than you are, of like, I know my numbers are looking great, but I have no idea if I'm actually good at this.
What was the question?
I'm just commenting, and I'd love to hear any reactions to that.
Yeah, I think. Yes, I think that this is a rising tide lifts all boats kind of market right now. I mean, COVID has been a big, tragic macro event that has had a lot of positive impact on the tech industry, and so it's an unusual historical circumstance to be in, and a lot of investors will be tested over the coming years on whether the success that they are having during this period will carry forward.
Yeah, absolutely. Awesome. All right. Next up, we are going to go to Hari. Hari Anamaraju. I'm so sorry if I mispronounced your name. And Hari, you can come on up and you can turn your video and audio on.
Hey, how's everyone doing? Hey, Liz, thank you so much for the opportunity, and Scott, thank you so much for the time. I really appreciate this, that you're investing in like a lot of our futures. It really means a lot for all of us. But my question, it comes to talking about how our pitch and presentation should be, right? So I think nowadays having a good PowerPoint is really not good enough. You have to find something really unique and bring something new to the table to kind of stand out in the pitch, because I think everyone has really unique ideas, especially nowadays. So what's kind of some tips for that, and how do you navigate the pitch and the presentation?
Look, the pitch is the presentation is just an illustration of the idea that you're building, and so yes, I think the presentation has to look good, because if it doesn't look good, then it sort of calls into question your capacity to communicate your idea well, and especially in a world that's increasingly branded and consumerized, it's important that you understand how to speak that language. So there's nothing that the pitch itself does not make for a fundraise. The quality of the pitch can kill a fundraise, but it can't make the fundraise happen. And so, the areas in which you win are in the strength of your thesis, and certainly performance or traction if you've got that. If you have a product and you've got some sales that can prove that you're already winning or on your way to winning, that can help a lot. But then it's really about also understanding the fit between you and the business that you're going after. We think of that as founder market fit. Does this founder have a privileged? When I say privileged, what I mean is a position where, because of their experience, they're uniquely positioned to succeed in the market that they're going after. And so, that's the best thing to do if you can do that. And if you can't, then you have to figure out how to build a team around yourself that suggests that even though you do not have that, the DNA of the team will allow you to get there.
Awesome. You're definitely inspiring a lot of future venture capitalists on this call. That's for sure. I'm seeing
hopefully entrepreneurs.
Yeah, I think both. So next up, we are going to invite Brooke Atherton up on stage. And while she turns her video and audio on, Brooke is a recent finance grad from Texas A&M and just started with Deloitte Consulting. So congrats on your new job, Brooke.
Thanks so much. Thanks for putting this event on. Like the former previous people have said, it really does mean a lot. Scott, the question I have is, what is the biggest challenge you have come across when you invest in very early stage companies? So in particular, like how does the team attempt to mitigate the inherent risk that comes with seed investing?
That's a tough question to answer because there are a lot of major challenges. Look, I think, maybe to answer it concisely, the biggest risk to a startup is the cohesion of the founding team. And so that's one of the areas where we spend a lot of time is trying to understand the dynamics between the founders. Are they complementary? Do they respect each other? And there are a lot of cues to the quality of the relationship between the founders. Some of them are pretty obvious, like how long have they known each other? Did they just, did they meet at a hackathon and they, last week and they barely know each other, but have decided to build a business together? Or, have they spent a lot of time together? Did they go to school together? Have they been friends? And so those are some of the things that we look for, but trying to understand and underwrite the quality of the relationship between the founders is a big part of it. In WayUp's case, Liz and JJ had just this amazing connection and longstanding friendship that made it really easy to very quickly identify that at least that part of the business was a no-brainer.
There's some stat that don't a large number of co-founderships break up within 3 years of starting a business?
Yeah.
I don't remember what it was.
Yeah, it's more than half. I can't remember the exact stat, but it's more than half.
Wow. Awesome question, Brooke. Thank you so much. All right. Next up, we are going to be inviting Nathan onto stage. And Nathan Salm is a student at University of Connecticut, so UConn. So Nathan, feel free to turn your video and audio on.
All right. Hi, everybody. Thanks for the event. It's really great. So I was just wondering, what industries within technology do you expect to see significant growth in for the next couple of years?
I mean, we think there's going to be significant growth in almost every area of the economy because of technology. And so the way that we, are sort of, if you look at our portfolio, I think you'll probably identify is that we're investing at what we call the application layer of the digital economy. So basically taking technology that's developed and applying it to different industries. So for example, we have a portfolio company called Convoy, which is a sort of an Uber-like marketplace for trucking. They build a lot of tools around that industry to help both the shippers and the truckers, the carriers. And so we, that's one example of applying technology and to an industry that has largely been neglected by consumer technology. We have another portfolio company called Sweetgreen that, if you're familiar with it, is a chain of farm-to-table salad bars. We are one of the first investors in that business, and it's a huge company today, worth over $1.7 billion as of their last financing. And there, they use technology to manage the supply chain in terms of purchasing produce from local farmers, managing the supply chain, managing the back of the house, anticipating orders, using technology and AI to do predictive analytics around ordering and waste reduction. And then the other part of it is half of their business comes off of their mobile app, which is basically makes them a direct-to-consumer company, even though they're operating out of brick and mortar stores. So we really think that this application of technology to all these areas creates tremendous amount of opportunity for disruption across almost every category of the industry, of the economy.
Awesome. Great question, Nathan. Thank you so much. And Sweetgreen, for anyone who doesn't know Sweetgreen, you got to go find Sweetgreen near you. It's delicious. So thank you for that investment and making sure that they could exist in my life, Scott. All right. Next up, we are going to invite Camille Anigbogu onto the stage. So Camille, feel free to turn your video and audio on.
Hi, can you hear me?
Yeah. Hi, Camille.
So I just finished my freshman year at the University of Houston, and this summer I'm interning with the Texas Commission on Environmental Quality. And like you, I'm studying liberal arts. So I'm a liberal studies major, which means that I'm triple minoring in liberal arts. And so I wanted to ask you, how did your studies in liberal arts help prepare you for your software startup?
I think the interesting, there are a lot of great educational paths, and there's no one that leads to more success than another, I don't think. I think what I do think is interesting about a liberal arts education is that it's really about connecting the dots. And so it helps you sort of understand patterns inside different disciplines. And it's that pattern matching or that pattern recognition mindset that I think is really valuable in navigating any business. Because navigating a business is a lot about identifying those patterns, what's working, what's not working, where can you learn from other businesses or other stories, or sometimes even history, and take those lessons and apply them to the business that you're building. And so I think the great value of a liberal arts education is that it's pretty broad. It allows you to get exposure into a lot of different areas of academic discipline and apply those to your algorithm that allows you to understand the business that you're building or the product that you're trying to bring to market. So I'm a big fan.
Fantastic. Congrats on your internship, Camille, and thanks so much for asking the question. All right, we only have time for a few more questions, but next up, we are going to invite onto the stage Zed Truon. Zed is currently, while he's joining the stage, Zed is currently a venture analyst intern right now at Peach Score. So Zed, thanks for joining. You have a great question, so I'll let you turn your video and audio on.
Hey guys, how's it going? Thank you, Liz, for hosting the event, and thank you, Scott, for being here. I've actually got the chance to only talk with one VC my whole life, so this is super exciting for me. I was just wondering, Scott, you could have gone from law school to high finance roles like private equity or investment banking. Why did you choose venture capitalism, and why? And how was the process of you scaling your business from starting your own firm from the ground up?
So why I picked this is because I just couldn't imagine doing anything else. I absolutely love, I'm passionate about entrepreneurship. I'm passionate about, helping people build the future of what the world will look like. I derive a lot of fulfillment from working with founders and helping them get to where it is that they want to go and being a small part of that. So for me, it's the most rewarding part of the journey is the start of the journey. And so that's sort of limited my relevant choices for my circumstance. Starting a firm is it's an entrepreneurial journey in and of itself. I mean, I'm effectively a small business entrepreneur that has a small team that has to raise capital, that has to build process, that has to do sales, that has to win deals, and has to compete, and has to do accounting and review tax returns and and everything in between. And so it's a lot more similar to being an entrepreneur, operator of a business than one might think. It's also a lot less glamorous than one might think. Oftentimes people think, oh, you're a venture capitalist, you're just sitting there and signing checks and investing in companies. And the truth is that is a part, and it's a fun part of the job, but it's by no means the exclusive use of my time. And so there's a lot of grunt work associated with trying to build a firm, and but it's also very rewarding when when you get into it and you start to see some success.
Great questions, Ed. Thanks so much, and good luck with the rest of your internship this summer. All right, I'm going to ask one question from someone who didn't want to go on camera, and then we'll go to William on camera. So I'm going to ask on behalf of Fawad Moabi, who is an MBA or Master's of Finance student at University of Maryland. And Fawad's curious about what you think some of the most positive changes that have come out of the pandemic for specifically venture capital have been.
Some of the most positive changes that have come out of, it's just such a hard thing to say that there's been positive changes that have come out of the pandemic. But having said that, for the tech industry, it's accelerated a lot of trends. And so, I think we sort of think that for many industries within tech, it's accelerated adoption by somewhere, by probably close to 5 years. And so you see that in e-commerce, you see that in obviously telecommunications like Zoom products. So there's a lot that's happened. I think a little bit more operationally, what's happened that has been interesting is that we've sort of got, as a venture capitalist, we've gotten a little bit more effective with our time. because a lot of our meetings now are done on Zoom, which means there's less switching time between meetings. There's effectively no travel time between meetings. And so you can pack in a lot more throughout the day and be much more effective with your time, which helps you get to know more entrepreneurs, and it helps you go deeper with entrepreneurs a lot earlier on in the process. And so I think that's been a plus. The other plus is that related to that, venture capital, especially at the early stages, historically has been very geographically focused, because a lot of it is about boots on the ground, building a network, identifying founders within your town or your region that are just thinking about starting a business. And now being able to do so much more of this business on Zoom, it allows us to spend a lot of time with people across the country, or even across the world in a lot of cases. And and that's exciting, because it brings you a breadth of diversity of opportunities and of perspectives that previously were a little bit more difficult to access.
It is so wild that I remember a couple of years ago hearing from one of my friends that she had just closed $100 million round, or maybe it was above 100 million, all over Zoom. She had never met them in person or over whatever, and it was so amazing back then. And now that's every round. It's pretty wild.
Yeah.
Awesome. All right. Let's go over to William Ritchie. William, you can come on stage and turn your video and audio on. William is a University of Houston student majoring in finance. So William, take it away.
Thank you for having me. I was just curious about APIs. I think JP Morgan Chase and Goldman Sachs were talking about the future of finance to be found in APIs. What's your opinion about this and utilization of artificial intelligence and machine learning from a VC perspective?
This is going to be a little bit glib, but I think the future of everything is APIs in a lot of ways. There are more and more industries that are developing API platforms, sort of similar to Plaid in the finance industry, that are allowing to build this interconnected tissue across otherwise disconnected, disparate systems. And the opportunities that those will open up for a lot of industries are pretty remarkable. And so, I think it is. I think the answer is yes. That I think that is true. That APIs are going to have a massive impact. I think those are going to have a disruptive impact on human labor in some negative ways, and probably in some positive ways as well. And so the broad API category, whether it's in finance or elsewhere, I think is one to be watching, and certainly one that we're investing in.
Awesome. Great question, William. Thank you so much. All right. The final question I'm going to ask this on, they asked to keep it in writing, so I'll read it out, is from Kevin Zai. Kevin is a student at NYU, and it's a great question. As an early stage investor, how do you balance seeing the best case upside scenario of an investment versus the rational optimism necessary to not make an outlandish and overvalued bet?
Well, that is an art and not a science. It's certainly a tough thing. Now, having said that, since we are investors at the seed stage, when we're investing, as I mentioned earlier, it's a few people with a prototype of a product, or sometimes just an idea. And so while at times we may be paying a little bit of a higher price than we would like to for a deal, it's nothing compared to what you see at the late stages. And so in our case, it's a little bit less of an issue, but it's hard to evaluate, because the size and scale that these tech-enabled businesses can get to today is really remarkable. I mean, to see $100 billion IPO today is not unheard of. 20 years ago when I started my career, that just didn't exist. $1 billion was an incredible exit, and now $1 billion is, you've done well. And so it's the scale of the potential outcome is one of the things that's driving people to pay higher prices on deals at the time of investment. And the reason for that is, while you may lose money on that investment, the payoff, if it works, because of the power law distribution of returns in venture capital funds, when the payoff works, it's well worth the investment, even if you had to pay a little bit more at the entry point.
Fantastic. Well, thank you so much, Scott, for doing this. To all the future entrepreneurs and venture capitalists on here, I hope you found this interesting and helpful in your own journeys. Scott, so that people can follow you, are you active on Twitter or LinkedIn? Where should they look for you?
I'm sorry, my daughter just walked in.
That's okay. She can join too.
Okay, it's all right. Come on, sit with me for a second until we wrap up here. She's got an earache, so she's a little bit cranky. Can you say hi? No, you can't say hi today. We're a little bit active on Twitter. You can reach me at Scott D. Birnbaum. We've got an email address for sort of anybody that wants to reach out to us, which is hello@Red Sea Ventures. And that's probably the easiest place because it's otherwise our inboxes get flooded, and that's at least an area we make sure to take a look at so that we respond to people. And yeah, those are probably the best ways to get a hold of me.
Fantastic. And just as a reminder to everyone, if you scroll up just a little bit in the chat, you will see that we also have the links to the Red Sea Ventures principal position as well as analyst position that you all can check out. So Scott, on behalf of everyone on the call, thank you so much to everyone who joined. Thank you so much for spending an hour out of your week with us. And I really appreciate it. So, and take care. Oh, she's so adorable. So,
Thanks for the time. Thanks, everyone.
Take care.
Bye-bye.